Okay, so good morning guys. We will continue our discussion on corporations and finish off this chapter today. So we will start our discussion about preferred shares and why they are called preferred and where the preferences are. But before I do that though, I would like to explain the concept of dividends. So at the end of every year, a company has net income and then they pay taxes from that net income. After tax net income can be used for different things. One item that the company can choose to use it is to expand. Another may be to pay off some loans. Another option may be to pay some dividends. Dividends are part of that net income which is being distributed to shareholders. So the dividends can be paid to common shareholders or preferred shareholders. But preferred shareholders would get their dividends prior to common shareholders do. So now let's go through the preferences that preferred shareholders have. They have, first of all, liquidation preference, which means that in the case of bankruptcy, preferred shareholders would get their dividends and their money, their share, the value of the shares, prior to common shareholders do. So these preferences are over common shareholders. Cumulative dividends. So in a given year, if for some reason a company was not able to provide dividends to preferred shareholders, they are not allowed to give any dividends to common shareholders until they pay back all those dividends in arrears for preferred shareholders which they should have paid in those years which they were not able to. Another preference is convertible to common shares. Preferred shares have this conversion feature where they have this ability to be converted to common shares if the preferred shareholder would like to switch from being a preferred shareholder to common shareholder. Then you also have a redeemable option, which is the option is for the companies. The companies can actually redeem preferred shareholders and preferred shares and issue those shareholders common shares. And a retractable option. A retractable option is for the shareholder. They also have this option of giving the preferred shares back to the company and asking them to issue them common shares. So there's quite a few preferences. The main ones being the first two, where the liquidation is there's a liquidation preference over common shares, common shareholders, and the cumulative dividend preference over common shareholders. So how does the cumulative dividends preference work? Basically, preferred shareholders must be paid both their current and any outstanding dividends from prior years before any common shareholders are allowed to receive dividends. So we talked about that in a couple of minutes ago as well, but I just want to re-emphasize this. Preferred dividends not declared in a given period are called dividends in arrears. So anything that was not being declared, you must declare them prior to any common shares. So if we go back to this slide, we remember that the preferred shares are being listed prior to common shares on the balance sheet, on the shareholders' equity section. And you can see there's a $9 preferred share in this case, which means the $9 is the dividend. So this dividend must be declared prior to any common shareholder being receiving their dividend.
Mr. Broussard, Ms. Woltenberg, please call the office immediately. Thank you.
So, excuse that interruption, please. So, we will move on from there to the next slide, where the order of payment in a liquidation is being talked about. So, what happens in a liquidation is, in a bankruptcy situation, an outside party is being usually given the option of looking after this company to try to come out of bankruptcy. But if they cannot and the liquidation must take place, then this is the order where the accountants who are doing the liquidation, they are called trustees in bankruptcy. They are specialized accountants. again, they're called trustees in bankruptcy, and they are the ones who will be taking the money out of the company, the assets out of the company, and paying down the loans. And after all the loans, once they sell the assets, this is how they will pay down their loans and expenses. First of all, because they are the ones who are taking control of the company, they will get their accounting fees first. So that is the first thing that is being paid by the company that is going bankrupt. Then you've got taxes. So that's the second thing that is being paid by the company that is going through bankruptcy. Third is bank loans. So bank loans have a definite priority, as you can see, over the others. And then there's other creditors. You might have accounts payable, you might have other notes payable and things of that nature. Then there is preferred shareholders. And after preferred shareholders, there's common shareholders. So you see, out of the shareholders, preferred shareholders have this preference. And of course, if there's anyone else after that. So these are the major preferences for preferred shareholders, the two being the order of liquidation, the liquidation preference, and the second being the cumulative dividend preference. So we'll move on to a couple of different things now. ROE, return on equity. Return on equity is considered to be the most important measure of a company's profitability. So basically, if you are a shareholder, if you have equity into this company, if you have put money into the company, you would like to know what kind of ROE, return on equity, this company is making. So this is how you calculate this. You take net income, you divide that by average shareholders' equity, and you come up with return on equity. So what is this average shareholders' equity? Of course, what you do is you average the shareholders' equity for 2 years. Book value per share. Book value per share is simply the value of all common shares divided by the number of common shares that you have. So this gives you the book value of all the common shares at that point, or book value per share of all the common shares that you have at a single point in the balance sheet. So what happens when there is preferred shares as well as common shares? So what you do is you can calculate the preferred shareholders' equity, and you can also calculate the common shareholders' equity, and then from there you can easily calculate the book value per share of the common shares. So you can see you will take the number of preferred shares and you can multiply that by the book value of preferred shares, and you have the shareholders' equity for preferred shares. And then of course you can also have the the shareholders' equity for common shares as you can follow those steps. And then what you can do is you can determine the book value per share of common shares by taking the common shareholders' equity and dividing by the number of common shares. So as an example, if the total shareholders' equity is $250 would be the preferred shareholders' equity, you subtract that out and divide it by the number of common shares, which is 15 in this case, and you come up with a $10 per common share for the book value of common shares. So what is the difference between book value and market value? We talked about it really briefly yesterday. Book value is basically something which does not usually equal market value. Market value is basically that value of the company's shares which is considered to be a value which the investors or the potential investors are willing to pay each other. And that is the value which is perceived by the outsiders. The book value is simply the value where the common shareholders were sold at a certain price, and that maybe you've got common shares which were sold at different prices. So basically you need to come up with an average of those prices. So market value may be greater than book value, but it does not necessarily mean that the shares are overpriced. And that's where we will end our presentation today. So we've covered lots of stuff in this chapter. In this last presentation, we talked about basically the preferences of preferred shares and how to calculate certain things such as ROE and book value per common share. So I hope that you guys have learned a lot from this chapter, and we will move on in a couple of days to the next chapter where the discussion will be further on different aspects of the corporation accounting. Thank you very much.